Welcome to the channel. I'm Ehsaan from Spectrum CPAs. And on this channel, I break down Canadian tax so that business owners like you can keep more of what you actually earn. In today's video, I'm going to explain exactly how to pay yourself from your corporation. Salaries, dividends, or the right mix of both. Now, here's why this matters so much. So many people incorporate to save on tax, but then the business starts making real money and they suddenly realize they have absolutely no idea how to get that money out of the company and into their own pocket the right way without overpaying the CRA and without setting off a surprise tax bill down the road. And look, the last thing you want right when your business is finally working is to get in trouble because you paid yourself the wrong way. So if that's you, stick with me all the way to the end, because the single most expensive mistake I see has nothing to do with salary versus dividends. And I'm going to show it to you before we wrap. Let's dive in. The first thing you need to understand, the money sitting inside your corporation is not your money yet. I know, you earned it. But your corporation is its own separate person in the eyes of the CRA. So to move money from the business to you personally, you pull one of two levers. Remember that phrase, two levers. Lever number one is salary. When you take a salary, you're putting yourself on the company's payroll. That means you register a payroll account with the CRA. You deduct income tax and CPP off of every paycheck. You remit that to the government, and at the end of the year, you issue yourself a T4. And here's the thing, salary is a deductible expense for your corporation. The company gets to write it off. Lever number two is dividends. A dividend is simply a payout of the company's after-tax profit to you as a shareholder. There's no payroll account, there's nothing to remit through the year, you just need a director's resolution authorizing it. And the company issues you a T5 at year end. But keep this in mind, a dividend is not a deductible expense because it's paid out of the profit the company was already taxed on. Two levers, two different sets of rules. Now don't worry, I've got you. Let me walk you through how to actually set this up step by step. Step number one, separate your money, business bank account, business credit card, completely separate from your personal accounts. Do not mix the two. Co-mingling your money is how you quietly lose deductions, and it's how you invite an audit. Everything else we're about to do depends on this one first step. Step number two, decide your levers, salary, dividends, or a blend of both. And I'm going to give you the exact framework I use in just a minute. Step number three, if you're taking a salary, run it properly. Payroll account registered, deductions remitted on time, every month, T4 issued at year end. And if you're late remitting, the CRA charges penalties. So this has to be clean. Step number four, if you're taking dividends, run those properly too. A director's resolution documenting it, a T5 issued to you, no CPP, and nothing left to remit through the year. And step number five, and this is the one people forget, set money aside before you pay yourself. Corporate tax, your personal tax, and HST if you're registered. I need you to hear this. The balance sitting in your business account is not all yours. Big chunk of it belongs to the government. Pay them first and in your head, and pay yourself what's actually left. Now here's a word of caution, and this is that expensive mistake I promised at the top of the video. The costliest thing I see is not choosing salary or dividends. It's owners who just transfer money to themselves whenever they feel like it. No salary declared, no dividend declared, just moving money around. When you do that, that money becomes what's called a shareholder loan. Your corporation has effectively lent you money. And there's a rule. It's section 15.2 that says you have until 1 year after your corporation's fiscal year end to pay that loan back. Miss that window and the entire amount gets added to your personal income and tax. On top of the corporate tax, the company is already paid on it. That, my friends, is real double taxation. And it gets worse. Even if you do pay it back, if that loan was interest-free or below the CRA's prescribed rate, it can create a taxable benefit all on its own. Let me show you how ugly this can get. I've seen an owner pull $200,000 out of their company as undocumented draws and never repay it in time. The CRA reassesses, and that $200,000 becomes fully taxable personal income. Now, add audit interest compounding at around 7% plus penalties, and that $200,000 loan balloons into a $300,000 plus tax bill on money they generally thought was already theirs. That is why documentation matters. Let's do the fun version. The one where you actually win. Let's run an example together. Say you're a corporation that's $130,000 this year. The very first question I ask every single client is, what's your lifestyle number? How much do you actually need after tax to live your life? Let's say it's $80,000. Here's scenario A. You need the cash. We build you a salary size to hit your goals, enough to create RRSP room, enough to contribute to CPP, and then we top the rest with dividends. Why salary here? Because salary is what builds your RRSP room. That's 18% of your earned income, up to $33,800 for 2026. And remember, you need those salary earnings in the first place to create the room. Salary is also what puts you into CPP. The maximum contribution is around $4,600 in 2026, and that includes the enhanced CPP contribution for the year. And salary is T4 income, which is exactly what a bank wants to see when they qualify you for a mortgage. Salary even helps if you ever need to make an insurance claim, or if you're claiming lost wages in a claim scenario. That T4 income is what backs it up. Dividends don't build RSP room, and they don't put you into CPP, and you can still qualify for a mortgage on dividend income. It's just more onerous because the banks want to see a longer track record and more paperwork. Now, here's scenario B. You don't need all the cash. Let me paint that picture. Maybe your spouse earns a strong income, and you personally only need a little to live on. In that case, we still pay you a small benefit-sized salary, but we leave the rest of the profit inside the corporation. Why do we do that? Because inside the company, that money is taxed at the small business rate. That's 11.2% here in Ontario, instead of your personal rate, which, let's be honest, can be north of 53%. That difference stays inside the company and compounds. And that right there is the real superpower of having a corporation, the ability to defer. Let me give you a real-world example of how this plays out. I had two clients in the same industry making roughly the same income on paper, but two completely separate corporations. One owner took everything out as a salary every year because that's what he'd always done. The other worked the mix, a benefit-sized salary, dividends to cover their lifestyle, and left the surplus in the company to invest. 10 years later, the second owner had a meaningfully larger nest egg, built with money that would have otherwise gone straight to tax. Same industry, same income, different pay yourself strategy. That's the whole game. Now, here's the part that most videos on this topic get completely wrong. People argue salary versus dividends, like one of them is some secret tax hack. It usually isn't. Canada's tax system is built on something called integration. Do it with me. Integration. And the whole idea is that whether a dollar reaches you as a salary or as a dividend, you end up paying roughly the same total tax once you stack the corporate layer and the personal layer together. It's not perfect. There's about a 1 to 3% swing depending on your province and your bracket, but it's close. So if the tax lands in roughly the same place, what actually decides your mix? The non-tax stuff. Salary builds RRSP room and CPP, dividends don't. Salary makes it easier to get a mortgage. Dividends don't disqualify you, but they make it more onerous. And leaving money in the corporation lets you defer and invest it, but only if you generally don't need it personally to live. So you see, It was never really which one saves tax. It's what do you and your household actually need. That's the shift. Last point, leaving money inside the corporation opens up a much bigger question. Where should that cash actually go once it's piling up? That's exactly what a holding company is for. And I break the whole thing down in this video right here. Watch that one next. But before you do, quick reminder, everything I just walked you through, your lifestyle number, your mix, how much to leave in the company, that's exactly what my team at Spectrum CPAs does for our clients every single year. If you'd like us to run your actual numbers and build your mix for you, there's a link in the description to book a free call. No pressure at all. We'll just show you what we do. All right, let's get into your questions. The first one comes in constantly. This one's from Priya. She asks, Ehsaan, what percentage should I actually take as a salary versus dividends? Great question, Priya. And honestly, there is no magic percentage. Anyone who hands you one without knowing your situation is guessing. I use these 3 questions with every client. 1, what's your after-tax lifestyle number? 2, which benefits actually matter to you? RRSP room, CPP, qualifying for a mortgage. And 3, where does your leftover cash earn the best return? Back in the business or set aside to invest? Answer those 3 and your mix basically decides itself. Here's a second one. This is from Marcus. He asks, do I have to decide this in January and lock it in for the whole year? Really good question, Marcus. And the answer is going to make your life easier. No. One of the quiet advantages of dividends is flexibility. You can declare them when it makes sense. So we revisit your mix every single year at year end because your life changes, your income changes, and your business changes. This is not set it and forget it. So that's how you pay yourself from your corporation in Canada. 2 levers, 1 framework, and 1 very expensive mistake to avoid. If this video helped you out, do something for me. Hit like, subscribe so the CRA never catches you off guard, and share this with one incorporated business owner who's still guessing how to pay themselves. It might generally save them thousands. I'm Ehsaan from Spectrum CPAs. I'll see you on the next one.